Well, now that we've learned the basics of banking and all that it is, let's move into an important area: credit cards, auto loans, and home mortgages. These are such basic things for all of us, things we use each and every day. But to maximize their value and stay out of trouble, we need to understand everything about them and how to manage them. So let's join Steve as he walks us through the world of credit cards, auto loans, and home mortgages.
Yahoo! I feel rich! Well, that's the instinctive response most of us get when we open up the mail and find our brand new, untouched, and yet unsigned credit card. Let's celebrate and break this in, we often say. In America today, the average household has 3.5 credit cards with a balance due of over $15,000. The interest rate is around 15% on average, which then leads to an average default rate of about 11%. Are credit cards to blame for the economic malaise that is setting in across our land? Or are credit cards a hero invention that have led us to lead a lifestyle unparalleled in history? I want to explore that with you and learn how you can maximize the benefit you get from these devices and minimize the curse they bring to so many people. Realize, if you will, that credit cards are a recent invention. In the 1950s, it was Diners Club that started with a charge card, and that was quickly followed by American Express. These charge cards were greatly different than credit cards we see today, as they had no credit line per se. You charged what you needed and then paid the balance at month's end. Your credit limit was based on your prior spending habits and your timeliness of payments. At the time, these cards became signs of status and power. American Express is still like this. Now, in the 1960s, MasterCard and Visa came along. They differed from these charge cards in that they were offered by banks, and they were basically unsecured lines of credit issued by those banks. Now, initial credit lines were small. They were based on the information that could be gleaned from your bank history, primarily your account balances, and then your history with the card. The more responsible you were with a card, the more credit would be extended to you. By the 1970s, credit cards had come of age, and virtually everyone could get one. A new fad among the credit card companies was to begin extending credit to college students. There were several benefits that accrued to the companies from this. First, mom and dad usually bailed junior out, so the bill got paid. But second, the young person was becoming addicted to the credit society and learning how to get things before they were paid for. And remember, it wasn't long before this that the concept of a layaway was popular. Well, credit cards are the opposite. In a layaway, you put something aside at the store and they hold it for you until you had paid them enough to take it home. Well, with a credit card, you got it first. What a wonderful thing. You mean I don't have to earn the money to buy that pizza? Wow, cool. Then there became an explosion in the 1970s and the 1980s as the broad offering of cards extended. Retailers jumped on the bandwagon, and it seemed everyone wanted to be in the credit offering business. Why is that? Well, how about making 15 to 25% return on your money? That's why. And that return didn't include the fees that could be charged for missed payments, over-limit charges, and all the rest. It was the perfect game. Give someone a credit card, let them run it up like free money, and then hit them with interest and fees so substantial they'd never pay it off. But what they would do is get yet another larger credit card and then pay yours off. Then, after swearing off that first card, well, what do you know? They'd go out and run it up again. What a business. Now, to be fair, there are 89% of our consumers in America who still are responsible and pay their credit cards on time. And those credit cards to them add a great deal of convenience to their lives. You don't have to worry about carrying cash, and you can always use a little extra credit if you need it until your next paycheck. So we know that credit cards are A, dangerous, B, convenient, and C, readily available. So how do we optimize our usage? What credit cards should we carry? And what happens if we're in over our heads? Okay, let me cover that last question first. What happens if we get in over our head? Well, if you're in over your head, my first comment, my first suggestion, and my first command is to stop. Stop living beyond your means now. If you have to cut back on cable television, cell phones, dinners out, movies, or any other non-essential, do it. You are lying to yourself if you think you can continue living in a deficit by just borrowing more and more without getting deeper into trouble. Now, of course, someone's going to say to me, but I have a huge check coming in at some point in the near future. I have commissions or I have an inheritance. Well, to those fortunate few, my advice stays put. Do not live beyond your means. You will regret it. And if you have that big check coming in, protect it. Look, I'm not here to tell you how to live, or maybe I am, but I will share with you a fact. The most precious resource you have is, now guess what? Many of you are going to say your health. Some of you will say wealth. Well, let me tell you, the most precious resource you have, the resource to be cherished above all else, the resource to be truly adored and truly enjoyed is time. It is the only resource you have that is inherently limited, and for some, all too much. I can guarantee you, having personally lived in a world with mansions, Rolls Royces, vacations, toys, and all the rest, my happiness was never greater than when I had the time to do what I wanted, and to do what I wanted with the people I wanted to do things with. Period. I don't care what kind of a house I live in. I don't care what I drive. But to have the time to do what I want, to live life on my own terms, that is, at least for me, my sole goal in life. Why am I doing the Steve Beeman Group? Because I love it. I love everything it is. I love everything it hopes to be. And I love the impact it can have on people. It's a labor of love. I would rather do this and live in a smaller house with a lesser car than anything else. And to do this, I need to A, be willing to live within my means, whatever that allows, B, protect any capital I have from simple expenditures so that I can use that capital to buy more time. Honestly, I could easily do a 30-minute message on time and how precious and critical it is. But as it relates to credit cards, step number 1 is to not buy into the lies of Madison Avenue and feel the draw to use them to live beyond your means. When you see commercials that say, for everything else there's MasterCard, run away. Credit cards and their abuse has created a multi-billion-dollar industry of both sellers of credit and now sellers of credit repair and credit management. You can spend thousands trying to fix a problem you got into simply because you lived beyond your means. And don't be fooled by companies that offer wonderful solutions that are too good to be true. They are. Yes, it's true that you can successfully negotiate with purveyors of credit cards to reduce balances. I've done that. And yes, you can stall on payments for a long time. Folks, I've done that too. And yes, if you get into real trouble, there are consumer protections known as bankruptcy acts, which aren't, by the way, as scary as they seem, but they are irreversible. So there are solutions if you get in trouble, but the best solution is to not get in trouble in the first place. In our CD program on budgeting coming ahead, we'll be discussing ways with you to stay within your budget and, frankly, how to budget. But always remember, if you're using credit cards to buy things you can't afford, do not buy into the lies of people who say, oh, don't worry, it's only $20 a month. So moving on, which credit cards do we use? Which one gives us the most bang for the buck? The answer to that isn't completely universal. There are different cards for different needs. For the person who travels, for the business person, for the young person, for the old person, each of these groups has slightly different needs. But for today's purposes, I'm going to focus on the retail consumer. That's just you and me. First things first, you can visit a website called creditcards.com, and that site will walk you through the dozens of choices you have based on any number of criteria. But let me continue to beat the same drum. Look for no annual fee, look for low interest, and look for no service charges. My favorite, and the card I carry for personal use, is the Capital One card. I pay no annual fee, and I pay no interest because I don't carry charges past 30 days. And as a bonus, I accrue miles. Now, for most of my life, I've also been a fan of American Express, partly because of ego, partly because of the no credit limit, and so that's definitely my number 2 option. Why? Yes, I pay a fee, but if I ever have an emergency, I know American Express is good to cover it. Now, your personal circumstances may differ, but here's a guideline for you. The average American earns $60,000 a year or $5,000 a month. That's an average family of 4. After tax, they're taking home around $3,500 a month. Okay, rule number 1, under no circumstances should you secure credit cards in excess of $3,500 total credit line, or 1 times your monthly net income. And don't lie to yourself. Don't get 2 credit cards at $2,000 thinking that that's under your credit limit. Well, that's $4,000 in credit, and it only hurts you to lie to yourself. Limit your credit to no more than 1 month's take-home pay. Now, being reasonable and prudent, of the $3,500 that you net each month, you do have fixed expenses as well, like car payments, mortgages, and required payments like gas and electric. So in reality, your spending money may be more like $1,700 a month. So if you're really honest, you shouldn't have more credit than that $1,700 per month. Or maybe even less, knowing that some of your spending money is spent using debit cards and checks. I know, to many this is going to seem radical, but folks, you and I both know that a person who on average has $1,700 a month in spendable income and carries an average of $15,000 in debt will quickly get into trouble. So don't go there. Become a self-responsible person and do not buy into the lies of a better life. It's not a better life. To be a slave to the past is no way to live, and that's exactly what credit will do to you. Now, virtually anyone can get a credit card with a $1,000 limit, so make sure you get no fee, bonus points, and no service charges. If you're in over your head, quit using all of your credit cards now. In a future CD, we'll share with you how to get out of debt, but today, stop it, stop it, stop it. Use one card with a reasonable credit limit, and together with your debit card, you should be fine. Now, the final question, which was the first one asked, is how do I optimize the usage of my cards? The Capital One card that I carry, remember, has no annual fees and no service charges and does offer bonus points. So yes, I try to put as much of my monthly free spending as I can on my Capital One card. Let's review though. I don't put my whole budget for spending on the card because I know a fair amount of my free spendable money is spent in cash, debit cards, and checks. Well, in my personal case, it's about 50-50. 50% of my spending money is spent using cash, debit cards, and checks, and 50% is available for use on my credit card. So I use my credit card for roughly 1/2 of my monthly expenditures. That way, I'm never in over my head, I'm accumulating points, and I'm paying no annual fees. Remember, take care of the pennies and let the dollars take care of themselves. Let me move on. When I was 17, a senior in high school, I got my first car. I leased a brand new Buick that cost me, and yes, I remember exactly, even though it's 30 years ago, $277.01 per month. Now, adjusted for inflation, that's around $500 per month in today's dollars. I got this car because I needed it for business. As I've said earlier, I was selling cookware door-to-door at the time, so I drove each and every day to my different territories. Additionally, though, I wanted my own car just like most high school students want. Well, I quickly learned that in order to own a car, you also had to own insurance. Whoops, tack on another $100 a month for that. And to drive the car, you had to fill it with gas. Oops, tack on another couple $100 a month. Pretty soon, I was spending almost $600 a month on that car. Now, bringing it forward to today, that's almost $1,100 a month. Now, at the time, I was making relatively good money from the commissions I brought in, so I could cover it. But I quickly developed a feeling of I needed a car for work, so I worked to pay for my car. Talk about joining the rat race. Now, there are some basic pieces of information you must know to build a prosperous financial future. What are these? Well, one of the first concepts that you must wrap your brain around is that cars depreciate. That $30,000 car you drive off the lot is now worth $23,000, and you've lost $7,000. It may not feel like it because you've buried that loss in your 48 or 60 months worth of payments, but it's as real as it gets. Robert Kiyosaki, who wrote the Rich Dad, Poor Dad series, came to a conclusion that I had long ago, and that is simply that rich people, however you define it, don't spend their money. Rather, they invest it. And investing, rather than spending, is a fact-based system, not an opinion, not an emotion, as many would have you believe. Cars do not improve in value. Unless, of course, you buy the right car, you don't drive it for 30 years, and you keep it in pristine condition. Then, if you bought the right car, it may appreciate. But even then, typically the appreciation won't match what you might have done in other assets. So don't fool yourself into thinking of your car as an investment. It's not. It's a necessary expense, but it's not an investment. Okay, so the second critical piece of information is the financing of your car. Let's be honest with one another. It's probably best to just pay cash for a car given that it depreciates. But there are circumstances when leasing or buying on credit might make sense. Notice I said might. First, according to Consumer Reports, a typical car has an 8-year, 150,000-mile operational life cycle. Above that in years or above those miles, the cost of sustaining safe operations may well exceed the cost of acquiring a new car. So as you think about your cars, at least from a prudent financial position and becoming wealthy, you should plan on trying to keep your car as long as possible to maximize your value from that expenditure. The notion that we always have a car payment, that notion is another fancy lie brought to us by Madison Avenue marketers. It's simply not true. So let's look at other financing options. First, you certainly don't have to consider only the bank anymore. The car companies themselves own finance companies like Ford Motor Credit or GMAC. These companies exist to finance cars and frequently will offer better deals than banks because they have huge incentives to move the cars. Today, for example, the car finance companies from Ford, GM, and Chrysler are offering either 0% interest or very low interest. With this, while it's never the most conservative way to buy things, if you have to finance a car, it's quite attractive. Well, let's not think about the lower payment because it's not really relevant on that. Let's think about the money involved. Assume for a minute that you have options on the money you're committing to the car expense. Now, I'm going to restate this again. It's almost never financially smart to borrow money on a depreciating asset. Okay, but with that said, if I have the cash to pay for the car, therefore I'm being prudent, and I can borrow money for the car at 0% interest, and I'm disciplined enough not to spend the cash on something else, but truly to invest it, well, then and only then is it financially smart to borrow. And here's why. If the car costs $20,000 and therefore you have $20,000 in cash that you can invest, in ultra-conservative investments today, you can generate about 2.8% a year in return. After tax, for most people, this reduces to about 2.5%. But okay, given that, if you now put up the $20,000 and pay cash for the car, at the end of 8 years, you have a car that's maybe worth $2,000. And you have the accumulated payments that you did not have to make because you paid cash. Okay, at 0% interest, your payment would be about $330 a month. So let's assume you saved that money and then compounded it at 2.4% for 5 years. At the end of 60 months, you have $21,230 in after-tax cash plus the car that's worth $2,000, so you have $23,000. So you've earned a whopping $1,200 in return for making 60 months worth of payments and incurring the risk, albeit small, of some future problem. If you finance it, you have a slightly better option due to the 0% interest rate. If you finance the $20,000 and invest that $20,000 in cash at the same 2.5% after-tax interest rate, you end up after 60 months with a car worth $2,000 and $39,000 in cash, or a total of $41,000. So in this world today of free money, it may actually make sense to finance your car if you can get 0% interest. But keep in mind, this only works if your interest rate paid is less than the interest you can earn from risk-free transactions, and you're disciplined enough to save the money and not spend it. It's a little more complicated when they then tell you, well, it's 0% interest or $2,000 cash back with a 2.5% interest rate. The question is simply, is the time value of the $2,000 worth more or less than the interest you'll be charged? I'd take the 0% interest again, of course, given the mathematics. Now, let me back up a bit and remind you that this is a highly unusual circumstance. Only the best customers, credit rating-wise, get the 0%. Now, in future discs, we'll show you how to increase your credit score. But for today, the bottom line is this. Do not buy more car than you need. Do your best to save the money and pay cash, and realize that you're consuming money, not investing it. And only in a circumstance where you can borrow the money for significantly less than you can invest it, should you consider borrowing it. Now, one final part of the car finance equation is leasing. Okay, here's leasing in a nutshell. The finance company looks at your car, and let's take that $20,000 car, for example, and they run an estimate of the depreciated value after 5 years. Well, let's say that's $7,500. And then they amortize the difference, in this case, $12,500, over the payments that you're obligated to make. What this does is, in effect, lower your payment so you can buy more car than you can afford. And secondly, it sets you up to make perpetual car payments because you never build any equity. Even if that equity in your car is small, it's still there. But if you buy the car, even on payments, and after 5 years the car is worth $7,500, your loan balance will be approximately $7,200. But, and this is a key, you're not obligated to secure another car. You can drive your current car for 3 more years or so and have no payment at all. Thus, if you now save the $300 per month in payments, after another 36 months of driving your now used car, you will accumulate over $12,000. So you see, no matter how you cut it, you should do what is common sense to most financial advisors. Minimize your car expense. Drive your car longer. Never lease, unless it's a business car, and then maybe it makes some sense. But be disciplined enough to invest the money that you save. Remember, if you don't have the money to buy your first car, just by being prudent, you'll definitely have the money to buy your second car. And we're going to cover more on that in the future sessions on budgeting. Let me move on to another comment. Everyone should own their home. This was the advice given by our grandparents, our parents, and lately even the government. A nation of homeowners is a more civil nation, a nation with more people that have vested interest in all things related to society. But is that true? Is the economy that you and I live in today manifestly different so that it may not always make sense to buy a house? And if we do choose to buy a house, how do we avoid the traps that have been set by others so often that cause foreclosures and financial heartache? Well, let's explore this in two sections. First, the economics of owning a home, and second, the financing vehicles. Okay, so should we or shouldn't we stop living in the world of renters and move to the world of homeowners? That's actually a better question than most people give it credit for. Traditional wisdom is that buying is always better because you're building equity, and equity equates wealth. Well, generally, that's probably good advice, but there are a couple of circumstances in which owning is not the financially smart thing to do. One of these is within your control, and one of them is totally out of control. Let's discuss the one that's in your control. If you think about the nature of a mortgage, and let's think about just traditional mortgages more than the variable rate mortgages that are so popular and so dangerous. As most of you know, on a 30-year mortgage, your first years are devoted to interest payments only. They have very little impact on principal at all. And there's a cost to securing the mortgage. We frequently see points on the front end, and if you don't know what that is, points are simply a cost stated as a percentage. So if you see a 0 points closing cost, there's no upfront charge for interest. If, like so many, you see 3, 4, or 5 points added to the upfront closing cost, those are pure costs to you. Now, the purpose of these points is in effect to prepay the interest charge. And simply, it reduces the risk to the lender, so they do it. Now, you also pay attorneys, real estate agents, closing agents, transfer agents, and other costs. In fact, according to Bankrate.com, last year, on the average $200,000 home, the upfront costs were in excess of $3,000. That's over 1.5% in charges just to buy a house. Well, the bottom line of this issue is that if you're not planning on staying in your home for a period of at least, say, 3 years, more like 5 probably, the cost of flipping homes more often than not will cost you more than the theoretical appreciation you'll see over the same period. Renting likely will make more sense in that scenario as it's less cost. Here's the mathematics. If you buy in today's market, you'll likely have to put at least 20% down, and you're going to have a fixed rate around 7%. If we simplify this and put math to it, the net costs on a $200,000 house after 5 years, if you buy it and then sell it, you're going to have around $46,000 in cash. By the same token, if you rent and then invest the down payment, you'd have around what? Well, guess what? It's $46,000 in cash. You'd have the same money with a lot more flexibility in your life, which translates to less risk. So this math is factually making the statement that the issue within your control, that is how long you'll live there, if that indicates you'll live in a house less than 5 years, you likely should consider renting. However, and here's the two-handed economist for you, on one hand, mathematically, renting may make financial sense. On the other hand, though, it depends on the second area of concern, the one that is totally and completely out of your control, and that is the macroeconomic effect. We're not within the scope of this segment to discuss a lot of macroeconomics, but here are 3 key scenarios you need to be conscious of when you make a decision, like whether or not to buy a house. Here you go. In a time of rising prices or inflation, it makes the most sense to hold hard assets like houses because as the dollars you own become worth less, the per dollar value of the hard asset will rise. We saw that in a big way during the 1990s and the 2000s in real estate. More money kept flooding into the market from more flexible lending programs, and that caused prices to rise. In that world, you're smart owning. And as you saw from the math we just spoke about, you're financially even with renting after 5 years, assuming no inflation to your price. If there is inflation, the math turns in favor of owning versus renting. Okay, but what about going forward? Do we have the same inflationary pressure that we've had for the last 20 years? Or on the other side, do we have deflationary pressures? Well, if inflation increases prices, deflation obviously decreases prices. Just as we had boatloads of money flooding into real estate in the 1990s and 2000s, we now seem to have the opposite. Money isn't chasing real estate, and that's causing prices to reduce everywhere. Now, in future CDs, we'll cover this in more detail when we cover investing. But take away from this that there are always two sides to a coin. And whether we should buy or rent comes down to a forecast of what the future will hold. All things being equal, rent if you'll live in a house less than 5 years, but if you'll live there longer, buy. Now, in addition to that equation, an increasing understanding of economics is necessary so that you can learn to make a forecast of whether we'll have inflation or rising prices or deflation and declining prices. Now, the second important component to homeownership is financing. You know, up until the 1930s, it was uncommon for banks to lend money to people to buy homes. It was usually an insurance company that did it, and they loaned the money on an interest-only basis with a large balloon payment down the road. That structure led to innumerable foreclosures, of course, because people couldn't come up with their balloon payments. Well, the Depression changed many things, and the law enacted in the 1930s changed the dynamics of home ownership. We don't need a history lesson in this session, but things have now evolved to a brave new world of home ownership. I've found that one of the hardest things to do in life is to learn from the past, but then not to be mired in it. I say that because the past of the home mortgage business is far behind us and likely not to come back. What I mean by this is that the easy money, no documentation loans, and the world of desktop underwriting that permeated our society in the 1990s and the 2000s has largely gone by the wayside. Bankers and lenders are becoming more and more stringent on making home loans because they've realized, gee, this took the bubble bursting. They've realized that real estate prices don't always go up. Sometimes they go down too. So lenders have become more rigid than ever on securing at least a 20% down payment based on an appraiser now that they know and trust, not just anyone saying, hey, this house is worth whatever. The loan types you can consider are predicated on a couple of basic factors. First, how long is your loan for? They were going up to 50 years, but most loans are in the 20 to 30 year time frame. Second, how much is your house worth? Above around $750,000 and you get into the world of jumbo loans where rates differ, approval processes differ, etc. Third, what is your FICO score? Now, we'll cover more on the FICO in future CDs, but then finally, what is your income status? Depending on all of the above, you may qualify for a traditional mortgage, which is a simple fixed-rate mortgage with a fixed time horizon. More creative mortgage companies are still offering variable rate loans with variable time horizons, though. For example, where a traditional mortgage includes some principal payment in your monthly payment, even though it may be small at the front end, some mortgages are for interest only for a period of time. This reduces your payment, but it also means you pay nothing off on the mortgage balance. Typically, these loans will have a period for which there's interest only and then convert to some form of a fixed mortgage. The scarier ones are the inverse interest mortgages. These mortgages allow you to pay less than the market rate of interest for a short time and simply add the accrued interest to the balance of the loan. Then, at some future time, you begin paying the normal mortgage. Well, all I can say is, welcome to the explanation of why the real estate bubble burst. You're telling me that a person can buy a $500,000 home with no down payment and a teaser payment of only, say, $1,600 a month, only then to see that payment jump to $3,600 a month after the teaser period is over? Folks, I'll state this as clearly as I can, and I'll summarize it with this. If you can't put at least 20% down and afford a standard 20 or maybe 30-year mortgage, and you feel comfortable that you're going to be there for 5 years, rent. Don't play the game. You'll suffer for it just as millions of others have. For a while, you'll live above your means, but the house of cards will come crashing down. The basic laws of economics demand it.
I see now how so many people get into trouble. These were important lessons on how to gain control of our financial lives, how not to become seduced by the advertising gurus on Madison Avenue into living large, with our paychecks, well, not so large. I think it's pretty clear now why none of us should enter the mystic world of mortgage financing without knowing exactly what we can and cannot afford. And now to an area that is important to everyone's lives: insurance. Let's join Steve as he explores the different types of insurance policies, what you need or don't need for your protection, and the risks that need to be managed when looking for different policies.
Sometimes in life, extremely complicated notions can be simply explained. In fact, so simply explained that even one word captures the essence of the entire notion. In the case of insurance, this is certainly the case. That one word, my friends, that captures the entire industry is risk. Now, you may be thinking to yourself, risk is a big word. How can it describe a whole segment of finance? Well, let's look at the Internet Dictionary definition of risk. Here we go. Risk concerns the deviation of one or more results from one or more future events from their expected value. Technically, the value of those results may be positive or negative. However, general usage tends to focus on the potential harm that may arise from a future event, which may accrue either from incurring a cost, which is downside risk, or by failing to attain some benefit, upside risk. So, risk can be summarized by calling it, let's say, the unknown. In our lives, you and I share a journey filled with unknowns. Let's start with the biggest. When will we die? And there are many more risks that we face, and they're plentiful. But many of these risks, in fact, for many of us, most of the risks we face have financial consequences. We cannot, for example, eliminate the risk of death. Death is, after all, the greatest equalizer and comes to all of us. But with that tragic event comes issues that bear risks we must endeavor to mitigate. For example, we encounter the risk to our loved ones that our death will cause them to lose their house or their livelihood. So these risks of living pose real and consequential outcomes. We're going to break this complicated topic into segments that attempt to unwind the complexity. We'll look at life insurance and the other forms of insurance of health and disability, and the impact of recent governmental action, home and auto insurance, including financial insurance. Life insurance is a large, very profitable, and very necessary business. Let's go back to the basic fact that we all of us will die. Period. End of story. Okay. But does that event have to cause economic hardship on our family and on those who depend on us for their livelihood? No. The insurance industry has grown up around the idea that by sharing the risk of any single person's death, they can so manage the risk that they can afford, for seemingly small amounts of money paid in, to pay death benefits large enough to support the responsibilities of any one person. And governments liked this idea because it eliminated the destitution that people might face, which would place them then in society's hands. So, there are given to insurance certain key tax benefits which are increasingly valuable, and as a result, there are any number of insurance products you can buy. Okay, life insurance has two primary forms. Term life, which basically means you pay a fee periodically, oftentimes fixed for some term, and should you die during that term, the insurance company will pay your estate the face amount of your insurance policy. The policy itself has no cash value, meaning that you're not accruing any savings in it. You're simply paying to mitigate the risk of your dying during some predetermined period of time. This is the least expensive form of insurance because it's the simplest and most easily forecast by the insurance company. Keep in mind, even though you don't individually know when you'll die, or your friends or your family, the statistics on death are plentiful. On an aggregate basis, we know very precisely how many 65-year-old white men living in Indiana who farm for a living will die this year. We just don't know which ones. So the companies that provide term life insurance have very good statistics on how many people will die and thus how much they'll have to pay out. From this, they can readily estimate the returns earned on premiums, and thus they can easily give you a monthly premium that, again, if you think in aggregates, covers the estimated payout and leaves a little in return for the shareholders of the business. This is a fabulous and profitable business, by the way. There are few shocks to the system, meaning that death statistics are extremely stable. Even when natural disasters are factored in, overall the statistics on death don't change. So term insurance is very efficient and very low cost for you and very profitable for the issuing company. The second type of life insurance is whole life or universal life. I'm oversimplifying slightly by lumping these two together, but they're very similar. If term life just covers the risk of your dying by paying a benefit should you die during a predetermined term, whole life and universal life take advantage of the tax code and allow you to save money alongside your death benefit program. Now, with federal taxes averaging around 20% for the average family, this is quite a boost for investment returns, and those returns can then accrue toward retirement planning or college funding. Now, within this subgroup, there are two types as well, fixed or variable. Fixed insurance programs simply fix the death benefit, whereas variable programs fluctuate the death benefit based on the underlying performance of the investments in the plan. Whether or not you should buy term or whole or universal policies are oftentimes a matter of pure opinion. Some are in favor of insurance, some are not. But let's look at the reasons to buy insurance. First, you're protecting your loved ones from the impact of your death, so that's term insurance, period. Second, you're looking at how to accumulate and manage your retained earnings. Well, that's universal or whole life insurance. These are separate issues. My personal preference is to buy term insurance to protect the financial interest of my dependents and then use other vehicles, including variable annuities, as the savings vehicle. Now, determining how much term insurance is actually quite easy. If a person earns $60,000 a year, that's around $3,500 a month, as we've discussed. So the goal is to ensure your beneficiaries that they'll continue to receive that $3,500 per month should you die and therefore be unable to continue earning income to support them. Well, okay, here's the math. $3,500 minus Social Security that averages around $1,000 a month leaves a $2,500 a month gap to fill. Okay, that means you'll need to earn $30,000 annually and adjust it for inflation. Now, a good rule of thumb is never draw more than 5% of your saved capital so that you ensure then having enough capital to last in perpetuity. So $30,000 at a 5% withdrawal rate equals $600,000. So there you go. That's how much term life insurance you need to keep your family in their same standard of living should you die. By the way, on another subject, that's also roughly the amount of capital you need to accumulate to retire with a sound and prudent use of your capital. Now, searching for which insurance company comes down to two issues. First, is the company sound? I could never say all, but most life insurance companies are financially sound. They weren't entangled at all in the meltdown that recently happened. However, you should most definitely refer to the professional advisor you have to make sure the underwriting insurance company is safe and sound and assured of paying your death benefit. Secondly, and this is simple, look for the cheapest policy. Different companies will differ on what they offer based on age, health, demographics, and other things. Some insurance companies require a health exam, some don't. This is especially true if you're seeking larger policies. Now, I know that many of the people who hear this message will think, I'm young, I have no dependents, and therefore I need no insurance. Well, you're partly right. You don't need life insurance per se, but I will say this. The earlier you secure a policy, the cheaper it is. So if you're 25 years old and you're looking forward to getting married and having a family, it may not be a totally bad idea to get a policy now. But those are hard to generalize about because what you're really trying to do is minimize cost. So you have to know the cost of the proposed policy for the 25-year-old and a similar policy for, say, a 35-year-old, and then do the math. By the way, if you have questions on that, we can help do that for you at stevebeemangroup.com. Well, if we've protected ourselves from dying, the question almost contrary to that is how do we protect ourselves from living? Well, the risks of living include many things, but chief among these are health and disability. Let me deal first with disability because the health issue could take a little longer. Did you know, for example, that according to Smart Money magazine, 1/3 of the American workforce will be disabled for 90 days or more in any given year? So what that means is look to the right, then look to the left. One of the three of you will fall into a category of people who are disabled for 90 days or more. Think about this for a minute as you sit with us today. What would you do if today you were in an accident and unable to go to work for 90 days or more? Would you have the financial wherewithal to sustain your family's lifestyle? Well, quite simply, disability insurance provides you income in the event you're disabled and unable to work. On a state level, it's kind of like workman's compensation. It pays out if you can't work. At the federal level, there's Social Security disability income. You know, interestingly, most people don't realize that Social Security actually has a disability component. It's not just for people over 65. If you're disabled at 35 or any other age, you can apply for Social Security disability payments. Well, the problem, of course, is simply that Social Security doesn't pay that much and likely won't cover the total cost that you have to sustain your standard of living. So just like with life insurance, there are a host of companies that engage in providing insurance to protect you against disability. Now, clearly, the rates are higher than life insurance because the probability of becoming disabled is higher, and the costs associated with disability are higher and less predictable. Now, you should be aware that most disability policies cap their benefits at 60% of your salary or $5,000 a month, whichever's higher. And from this, they're going to deduct Social Security and any state aid payments that you receive. So disability policies aren't always the greatest deals in the world, in my opinion, but they can offer peace of mind to the person who carries responsibility, has a little extra cash, and wishes to eliminate part of the risk of the scenario that will attack 33% of the population. A rule of thumb is that disability insurance should cost between 1% and 3% of your income. So if you make $5,000 a month, your disability policy will likely run between $50 and $150 per month, depending on your age, the type of work you do, your sex and health and all that. Now, for many people, their companies will pick that up on their behalf. But if you're self-employed, you really need to think about this as a prudent hedge for your business. Managing risk is a key part of the entrepreneur's life, and disability protection is but one of the important keys to that. Now, we're going to cover more of that in the financial planning section. Now let's spend some time on health insurance. Boy, talk about a hot potato. Our nation is facing rising healthcare costs, rising unemployment, rising financial deficits, rising expectations of entitlement, and all of the other dynamics that led to the creation of the Steve Beeman Group. I believe, and I believe history strongly supports this, that private healthcare is far superior to public healthcare, period. Just look at it even on the surface. Here in Chicago, where I live, if you have an accident or if you're sick, you can go either to Cook County General Hospital, which is a huge hospital, or Central DuPage Hospital, a very large private hospital. I can only assure you that one visit will convince you that a private hospital is a much better environment all the way around. But notwithstanding the editorial, let's look a little deeper into health insurance. First, as its name implies, it insures your health. The million-dollar question is, what does that mean? What is your health, and what rights do you hold? To some, cosmetic surgery is a need. And to some, that's a want. To others, a cut gets dealt with at home, while for others, that would require a visit to the emergency room. As you review your health insurance needs, you need to understand at the core what you're expecting from it. There are several key components to health insurance. What deductible do you want? Do you need a family covered or an individual? Is it for catastrophic problems or small day-to-day problems? Okay, let's recognize that due to federal tax imbalances, most health insurance is paid by your employer. The reason for this simply is that companies can deduct the cost of insurance from their incomes, thereby reducing their tax liability. Individuals cannot deduct insurance, therefore it's more costly to them. So for most of you, your company pays this. Now, I don't want to get political, but I do want to tell you the truth. For many of you, the recent healthcare legislation that was passed will force companies to eliminate healthcare coverage for employees. The reason is simple. It's cheaper. Under this new law, companies that eliminate a healthcare program for employees pay a $5,000 one-time penalty. And then the employee is required to go to a federal insurance exchange. Now, the law will require employers over 50 employees to either pay the penalty or provide insurance. Well, the bottom line, to the level that the insurance of an employee exceeds $5,000 per year in cost, employers will be incented to drop the insurance and have the individuals go to the state insurance exchanges for health care. So, more than ever, you need to become aware of the issues of health insurance, what it covers, what it does not cover, and what it costs. Now, the most commonly asked question of me is, what's a reasonable deductible? My answer to this is as high a deductible as possible, assuming that you're able to self-insure up to that amount. For example, if you can afford to put, say, $5,000 away and get a policy with a $5,000 deductible, it will be significantly less expensive as you're insuring only for costs above the $5,000 threshold. And for most people, you'll never use that money. Now, current law allows you to deduct up to $4,000 for an individual or $7,400 for a family and fund what's called a medical savings account. Whether you can deduct this or not is a question for your tax accountant, as there are innumerable circumstances where deductions get phased out. But for most, funding a medical savings account is a deductible expense. If you have to buy your own health insurance, especially as an individual purchaser, it's far better to fund this deductible MSA than pay higher premiums, which are not deductible. The new healthcare legislation and its impact on the national health insurance system is beyond the scope of this basic introduction, but we will be covering many more issues related to that at stevebeemangroup.com. Now, as management of risks, we've identified the risks of dying and some of the risks of living, and now we'll move into our property and our general liabilities. As you all know, we live in a very litigious society. As a result, we all face the possibility of a lawsuit. Now, that's a relatively new risk, and we need to add it to the pile of life risks. To prevent financial devastation from someone falling on our driveway and then becoming injured only to find some lawyer to sue us, there is now general personal liability insurance you can buy. It's inexpensive and offers broad coverage from things you say, things you might do, or things that people do and then will hold you accountable. General liability insurance can be a very good complement to a lawsuit-happy society, especially, again, if you're self-employed. As a self-employed person, you bear risks not usually taken by the normal W-2 employee. You have the risk at any time of an employee suing you, a vendor suing you, a customer suing you, and the list goes on and on. For a very small fee, you can get general liability coverage on you personally, which will help you sleep at night. The other two major insurance types you must be aware of, at least have some basic information about, are auto and home. Virtually everyone in America has or has had auto insurance. Like any insurance, the cost of this depends on your age, your sex, your driving record, the state you live in, and all that. There are three keys when considering car insurance: deductible, overall cost, and overall customer service. The deductible is how much you pay out of pocket before your insurance kicks in. Like with health insurance, I like to see people self-insure as best they can and carry larger deductibles. Yes, this means your money is at risk, but rather than paying it to the insurance company as part of your premium, which you will, you can invest that money and perhaps not use it at all. So an auto policy with a $1,000 deductible likely will save you, at least on a relative basis, a lot over a policy with a $100 deductible. One silly little note here, and for those who've experienced it, this is really basic common sense, but once again, it's shocking how many people don't know this. Most, if not all, auto insurance will not charge you to get a chip fixed in your windshield. So if you get one, don't delay. It will get worse and then it will cost you. Call up any one of a number of companies who will fix that chip in your windshield, charge you nothing, and therefore prevent you from being charged for a new windshield down the road. And don't forget that today, virtually every state in the union requires that you have auto insurance to drive a car. Most states offer low-cost minimum coverage policies that basically cover the other guy in an accident. So you can get these policies very cheap. And as it relates to this, by the way, not having proof of insurance in your car in most states will get you a ticket. So always remember to carry an updated insurance certificate in your car. Regarding homeowners and renters insurance, the same basic concepts hold true. Try to afford a larger deductible to keep your premium at a minimal level. These policies insure your building as well as your contents, so always remember to keep an itemized list. And of course, pictures help too, of anything you own that is of value that you'd likely claim in a total wipeout. For example, your computers, your television, your jewelry, your clothes, especially specialty items like fur coats. In the event that this risk of disaster is realized, you don't want to be haggling with the insurance company over the contents of what you really owned. Now, most policies require that you declare the insurable contents anyway, so it's just a good practice to keep good records. So, my friends, there's a basic introduction of insurance and of risk management. In later CDs, we'll talk about insurance against stock price declines and portfolio losses, and in other SBG casts, we'll cover many more specific questions about health insurance and especially the new healthcare system we're in. This is important but relatively simple stuff. Remember to keep your costs low, try to self-insure as much as you can. Of course, make sure you have the self-discipline to invest the difference in the premiums, and to explore risks that aren't simply related to life, health, home, and auto, but also consider disability, general liability, and so review your situation. And feel free, as always, to send us specific questions at stevebeemangroup.com. We welcome your questions and comments, of course, and hope to continue providing you information that helps you enjoy a smoother journey down your financial path as well as the other paths of your life.
Now that's the kind of knowledge that will help so many people in our audience. Steve has provided the ins and outs of this sometimes complex issue. Now on to additional basics. Join us now for budgeting.